Let us move on to the second aspect in credit analysis process, that is credit history. I mean, the bankers are going to analyze the credit history of the customer, and how they are going to do it, I'm going to explain through simple examples. Let's see. So again, I have categorized various scenarios by having two customers, A and B, and see in which customer the banker will have more comfort. Let's say two customers are approaching bank, and let's look at the number of loans outstanding for both the customers. Customer A has got 10 loans, customer B has got 4 loans. Or let's say the customer B has nil loan, no loan outstanding, no loan were taken in the past. Now, in which customer the banker will be more comfortable? Probably I would say with A, the banker can have a high degree of confidence provided if all the 10 loans are in good condition, right? I mean, Mr. A is managing all the 10 loans. There is no default, and the loans are not too high. It means, I'm going to use a technical term, he is not leveraged. I mean, he has not taken excessive loans. Only in terms of numbers it is 10, but in terms of volume it is low. So here the bank could go comfortable with A because bank can understand his credit history because he has taken various loans and he is regularly repaying those loans. It is not leveraged. But the bank can also say no to A if these 10 loans are not having satisfactory track record, he is not making payment on time, okay, and he has borrowed a lot of money. He is leveraged. In that case, A will be rejected. Now, with regard to B, it is difficult for the bank to come to a conclusion about his credit management because in the past he had not taken any loan. So they will not understand how this customer will react if he takes the loan, whether he will make payment on time, whether he will delay, or whether he will default. Okay, it means the credit history, the credit knowledge of this customer is very limited or absolutely nil. So bankers may have some kind of reluctance for B, but they will go ahead with Mr. B if the security what he is offering is going to be satisfactory, or the business what he is doing is generating good amount of cash flows so that they can be used for paying the loan without any difficulty. Okay, so A will be selected if all the loans are having good track record and it is not highly leveraged. B will be selected only if the security or cash flows are comfortable. Okay, that's with regard to number of loans outstanding. Let's say there is another parameter which the bankers are going to look at. That is EMI service date. We know that when bank gives loan, those loans have to be repaid on a fixed date. Let's say for both the customers, already they have taken a loan. Both the customers, they are supposed to pay their EMI, that is equated monthly installment, on the 5th of every month. Let us see when they are actually making the payment. Mr. A is making the payment on 5th itself, whereas Mr. B makes payment only on 10th. So in this case, obviously the bank will go with customer A because he has got credit discipline. The discipline is he is supposed to pay on 5th, he is paying on 5th itself, whereas B is paying on 10th, so there is a DPD. I call it as days past due, and this is going to put lot of hardship for the bank because bank is supposed to get money from Mr. B on 5th, but bank is getting that money only on 10th. It means bank is going to have asset liability management issues. Bank will have asset liability management issues or say mismatch issues because bank is not getting its money on time. So bank will have difficulty in meeting its obligation to others. So bank will not prefer these kind of customers. Next, let us look at one more scenario in understanding the credit history. Let's say both the customers have availed cash credit or OD facility, and these facilities will have interest servicing. Okay, let's say interest servicing is due on 30th June of every month. Now Mr. A will make payment only on 10th, whereas Mr. B will make payment on 30th itself. In this case, bankers will be interested in B because he is having that discipline, whereas bankers will not be okay with A because he's again putting the bank into hardship. Next, let's look at the CIBIL score. Now, what is CIBIL score? CIBIL score is the score which is going to reflect the credibility of the loan applicants. Now, this CIBIL score will be there for each and every individual, and we'll also have CIBIL parameters for corporates or say business entities. Now, how this CIBIL score is arrived? This CIBIL score is arrived based on the number of loans, based on repayments, based on various loan enquiries made, right? Then based on write-off, loan write-off, then if there is any one-time settlement. So all those factors will go into the CIBIL score. So if a customer has a great credit history, I mean he has manageable number of loans, all payments are happening on time, and he is not making roving enquiries with various bank for loans, and he has never gone or indulged into write-off or one-time settlement, then in those cases CIBIL score will be satisfactory. Let's say it will be 800 plus or say 880 plus. But if that customer has defaulted in any of the loans, I mean he is having issues in the repayment, or in the past he could not pay some loan, so because of that some banks had suffered a loss, so they have written off the loan. Or in the past he had taken a loan, he could not pay back the full loan, he had paid only the part amount, and part amount was waived by the bank through one-time settlement. Or he has lot of credit hungry, he goes and make enquiries in various banks, or he has too many loans. It means all those will bring down the CIBIL score, say to something like this or even below this. So which customer the banker will be preferring here? Is it 500 or 880? Obviously the customer will be preferring customer B. Okay, sorry, the banker will be preferring customer B because he is having good credit score. It means he is maintaining his credibility in the banking overall. Okay, next, relationship with the existing banker. The next parameter is the relationship with the existing banker. Now, let's say the customer already having a banking relationship, already the customer has availed a loan and they are doing it, but that customer has come to the new bank. So this new bank, how he will evaluate? So he will try to understand what is the relationship with the existing bank. Is it a smooth relationship or is it in the existing mode? Here Mr. A is having a smooth relationship, whereas Mr. B, the existing banker, is in the exit mode. They want to get rid of B. It means it indicates there is a strain, or it reflects his credibility to the existing banker, and that's why they want to get rid of B. And how the banker will get to know about all this? He'll get to know about all this when he interacts with them. Okay, I mean he interacts with the existing banker, and of course it's a very dicey situation because when the new banker starts interacting with the existing banker, then there is going to be say competition pressure, or the existing banker will try to retain the customer and new banker may lose that customer because existing banker may give some kind of a even softer package for the client or customer. So it's very dicey, but still they have to do it to understand what is the relationship. So in this case they'll be okay with customer A rather than B. And whenever a customer who is having a loan with an existing banker is approaching a new banker, then the new banker is supposed to get what is known as CIR. We call it as credit information report. And if CIR is positive, then they'll be okay with that customer. If CIR is negative, they will not consider that customer. Because in credit information report, the banker will say whether the contact of the customer is good or bad. And how they will generally write, they'll say satisfactory or not satisfactory. Okay, they'll say it is satisfactory or unsatisfactory. Okay, And let us also look at the loans outstanding position. Mr. A has got a loan, but he has no overdue. There is nothing overdue, whereas Mr. B has a loan and that has a overdue for 95 days. What do I mean by overdue? That is payment not happening on the due date. Payment is not happening on the due date. It means it has crossed due date more than 90 days. Okay, it means the payment is pending greater than 90 days. In this case, it is 95 days. Now, why I am stressing too much on 90 days? Because for 90 days, if the loan, its interest and principal is not serviced, then it will become non-performing asset, which is going to result in loss for the bank. Okay, so in this case, obviously, the bank will be okay with A and not with B. So let's summarize. The credit history is the key driver, okay, because it is going to reveal the past history. What are the loans they have taken? What are the loans they are servicing? Whether they are servicing on time? Is there any overdues, that is days past due? And they'll be looking at CIBIL, because the score will reflect the credibility, and credit information report from the existing bankers will give a key information to the banker if they are taking over a loan. Then something which we missed out is for understanding the credit history, the banker should go through bank statements. Now, this is not only going to give information about credit history, it will also gives information whether this customer has financial discipline by routing the transactions in the banking system, because not routing the transaction in banking system could result in creation of black money. Okay, so that should be discouraged, and if most of the transactions are routed through banking system, it means automatically they are getting accounted, and whatever the profit that is calculated is going to be the right profit, more or less. Okay, so let's just have a look at that. I mean, how the banker should scrutinize the bank statements. Again, I have two customer A and B, and let's see. So there's a customer A who has 300 transactions in last 3 months in bank, and it all customer initiated transactions, whereas customer B has only 10 transactions initiated by himself. Now in this case, the bank will obviously prefer customer A, because this customer has been routing all his transaction, or he is initiating a lot of banking transaction. It means most of his transactions are getting captured in the banking system, whereas that is not the case with customer B, because let's assume that both of them have same level of turnover, and this guy 300 transactions, whereas this guy has got only 10 transactions. It means Mr. B is covering substantial transactions. He is covering substantial transactions. He is not routing them through bank system, so obviously the bank will go with A. Now let us see some more information. Let's say the credits in last 3 months. For Mr. A, the credits that are coming to his account is, let's say, 50, whereas for B it is only 10, and again I'm assuming both of them are having same level of turnover. So again this is a matter of suspicion, because when both of them are having same level of turnover, how Mr. A is having more credit and Mr. B is not having? Because Mr. A has the practice of channelizing all the turnover receipts into the banking system, whereas Mr. B is not doing that. It means he can do some kind of a covering of transaction. It means at the end of the year, something may disappear from turnover, right? So again here, the bankers will be comfortable with A. Now, let us also look at the check bounces. Mr. A has issued, let's say, 100 checks in the last, say, 6 months. B also has issued 100 checks. Now, out of the checks he issued 100, 2 checks got bounced, whereas for B, 5 checks got bounced. So in this case, the bankers would be obviously comfortable with A, because he is maintaining his credibility, he is maintaining his integrity in the market. Integrity, that is the promise to pay. I mean, he's a person who can be relied upon, believed, whereas Mr. B, he is issuing checks left and right, but 5% of the checks are getting bounced. So again, the bank will be comfortable with Mr. A. Now let's say Mr. A and B has received 100 checks, from their customers. A and B has received 100 checks from their customers. For A, there is only one check got bounced received from the customer, whereas for B, 10 checks got bounced. Now again, bank will be comfortable with A because A's ability to repay the loan will depend upon the checks that are ultimately received from his customers. So here only one customer or one of 100 check is getting bounced, whereas here 10 of 100 check is getting bounced. It means the customers of B are not that trustworthy. So his cash flows will get blocked with them, and eventually B also will not be able to repay the loan. So bank will be comfortable with A. Next, critical routing of transactions. So whatever the sales that are reported by Mr. A, he routes them through banking channel only, whereas B routes only 10%. It means again the bankers are going to be comfortable only with A and not with B because A has got a lot of financial discipline, B does not have that, and B would be creating a lot of black money. Okay, so we came to this point when we summarized credit history, that is banker should go through the bank statements basically to check bounces because that is going to reflect the credibility and integrity. Okay, so by going through the credit history, as a banker will get to know what is the integrity. I mean, whether the customer has integrity or not, whether he has got intention to pay the loan or not, or whether he will default in future.